country in southeast Queensland. So there are concerns those cuts to superannuation concessions for the wealthy could lead to an increase in negatively geared property investment. Adding to that concern is the RBA's decision yesterday to cut the official cash rate by 25 basis points to a record low 1.75%. Most of the banks have now passed that cut on to borrowers, some only part of that. I'm joined now by Domain Senior Economist Andrew Wilson. Andrew Wilson, welcome. So what do you reckon the likelihood is of there being a heap of money that flows from these super funds now into property instead because of these tax cuts?
Well, like John, I agree there'll be a marginal effect at most. I don't think that there's enough energy in the level of those superannuation funds to impact housing markets to the point we'd have a price outcome particularly. I think those investor targets tend to be more middle income. And we are starting to see maybe some more investor activity in the markets now after a slow period last year. What
about if they're coupled with that interest rate cut from yesterday from the Reserve Bank?
Well, look, again, I think that tends to be more middle income investors rather than higher end superannuants. I think that the interest rate cut will again have a largely benign impact on housing market activity. We'll focus particularly perhaps on Melbourne and Sydney, which are stronger economies and have tighter housing markets. But I think growth would be 1 or 2% higher at best compared to what it is at the moment. So push Sydney up to maybe 4%. And Melbourne up to about 6% this year.
So looking more broadly at the budget then, What are the impacts on the housing sector over the coming years?
Well, it was a non-housing budget really in terms of specifics, but of course the key is the forward estimates in terms of where the economy is going. And I still think that looks pretty benign, and as usual there are always questions about whether they're optimistic outcomes. And I think the Reserve Bank is clearly looking at the inflation rate. That made yesterday's decision almost predictable when we got those very low inflation numbers last week. And I think that the chances are that they will continue. If they do, I think we've got another interest rate cut on the horizon because the Reserve Bank clearly wants to keep itself within that 2 to 3% annualised band. And I think that if it doesn't move up sooner rather than later, they will cut interest rates again. So it's about the forward estimates. The economy still looks a little weak, a little subdued going forward. So I think that those interest rate cuts are the main gain for the housing market from the predictions for the economy.
The resilience of the Sydney housing market in particular has been remarkable, hasn't it? And we had more evidence of that with those figures just in the last week or so.
Well, look, we've had a remarkable boom in prices in Sydney, 3 years, 54%. So I guess this was the pause we had to have. And even though the market has looked to picked up slightly recently, I think that it's just going to flatten until spring, and then we'll see some more sustained prices growth coming through. But it won't be anything like those double-figure results we've had in previous years. It'll be much slower and much lower, but maybe a little bit higher with those interest cuts yesterday.
And is there an oversupply issue at all with the number of apartments coming on in Sydney and Melbourne over the next 5 or 10 years?
Well, look, our data shows there's still an undersupply of housing in Sydney, around about 50,000 homes undersupplied at the moment. Different story in Melbourne. Of course, Melbourne's had that remarkable CBD building boom. The question is whether that's a unique market, isolated within itself and won't affect other parts of the local housing market down there. But there's clearly oversupply in that CBD market in Melbourne. Prices are falling now, but whether it affects other parts of the market is questionable.
And so looking ahead then over the next 3 or 4 years, what do you see happening with housing prices in Australia, and particularly with this discussion that we've had about negative gearing?
Absolutely, yeah.
And the differing perspectives on that?
Well, look, I think that's the elephant in the room. If we move away from monetary policy and fiscal policy, if we get a change to the tax mix for property, I think that will have an impact. Unlike many others, I actually think it'll push prices up, particularly in the short term, given that sunset clause, which I think will be a magnet to investors, particularly in the Sydney market. So I think that certainly has the potential to cause a disruption, a short-term disruption, particularly to the Sydney housing market with significantly higher prices until that cut-off point.
Okay, Andrew Wilson, thanks for coming in.
Great, Joe. Thank you.
And just before we get to other news, don't forget you can see the Treasurer's post-budget speech at the National Press Club live today from 12.